Hi. Let's learn about the dividend payout ratio. Today, we will talk about the dividend payout ratio is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. It is the percentage of earnings paid to shareholders via dividends. The amount that is not paid to shareholders is retained by the company to pay off debt or to reinvest in core operations. It is sometimes simply referred to as simply the payout ratio. The dividend payout ratio can be calculated as the yearly dividend per share divided by the earnings per share, or equivalently, the dividends divided by net income. Alternatively, the dividend payout ratio can also be calculated as 1 minus the retention ratio. On a per-share basis, the retention ratio can be expressed as the earnings per share minus the dividends per share, divided by the earnings per share. Several considerations go into interpreting the dividend payout ratio, most importantly the company's level of maturity. A new, growth-oriented company that aims to expand, develop new products, and move into new markets would be expected to reinvest most or all of its earnings and could be forgiven for having a low or even zero payout ratio. On the other hand, an older, established company that returns a small percentage to shareholders would test investors' patience and could tempt activists to intervene. The payout ratio is also useful for assessing a dividend's sustainability. Companies are extremely reluctant to cut dividends since it can drive the stock price down and reflect poorly on management's abilities. If a company's payout ratio is over 100%, it is returning more money to shareholders than it is earning and will probably be forced to lower the dividend or stop paying it altogether. A company endures a bad year without suspending payouts, and it is often in their interest to do so. Dividend payouts vary widely by industry and are most useful to compare within a given industry. Real estate investment partnerships, for example, are legally obligated to distribute at least 90% of earnings to shareholders. Dividends are not the only way companies can return value to shareholders, therefore, the payout ratio does not always provide a complete picture. First, if you are given the sum of the dividends over a certain period and the outstanding shares, you can calculate the dividends per share. Then, you need to calculate the earnings per share if it is not given. Finally, calculate the payout ratio by dividing dividends per share by earnings per share. For example, if a company had a net income of $50 million last year and the dividends per share was $1, then the payout ratio would be 11.1%. The payout ratio depends on the sector. For example, startup companies may have a low payout ratio because they are more focused on reinvesting their income to grow the business. While the dividend yield is the more commonly known and scrutinized term, many believe the dividend payout ratio is a better indicator of a company's ability to distribute dividends consistently in the future. The dividend yield shows how much a company has paid out in dividends over the course of a year about the stock price. The dividend payout ratio is a key financial metric used to determine the sustainability of a company's dividend payment program. It is the amount of dividends paid to shareholders relative to the total net income of a company. It is commonly calculated on a per-share basis by dividing annual dividends per common share by earnings per share. A high dividend payout ratio is not always valued by active investors. An unusually high dividend payout ratio can indicate that a company is trying to mask a bad business situation from investors by offering extravagant dividends, or that it simply does not plan to aggressively use. The dividend yield tells you what the simple rate of return is in the form of cash dividends to shareholders, but the dividend payout ratio represents how much of a company's net earnings are paid out as dividends. Here are 4 key takeaways. 1. The dividend payout ratio is the proportion of earnings paid out as dividends to shareholders, typically expressed as a percentage. 2. Some companies pay out all their earnings to shareholders, while some only pay out a portion of their earnings. 3. If a company pays out some of its earnings as dividends, the remaining portion is retained by the business, To measure the level of earnings retained, the retention ratio is calculated. 4. Several considerations go into interpreting the dividend payout ratio, most importantly the company's level of maturity. Hope this would help. Thanks for watching.